Let's quickly have a look at soft skin. Soft skin is a fairly good question. They have a building. They want the IS16 note from you. Now, the first thing that you should watch out for is that they didn't give you the cost price in a normal way, as usual, for the building or the property. They only tell you that they've issued 500,000 ordinary shares at 5 rand a share in exchange for the property. So obviously, the cost price of the property would have been 2.5 million rand. And then they tell you that in the current financial year, they decided to adopt the revaluation model on land and buildings, and they had a sworn appraiser to come and revalue the land, and he has certified that the land and buildings are worth 5.6 million. We have to do the IS16 note. So obviously we're going to start, look at your heading, proper heading, Soft Skin Limited, notes to the financial statements. If I talk about notes, it's always for the year ended 30 September 2020. Property, plant and equipment, land and buildings. Carrying value at the beginning of the year consists of the cost price, which is the 500,000 shares at 5 Rand, 2.5 million. At the end of the year, the building is worth 5.6 million. So what happened in between? There was a revaluation. So I debited my land and buildings account with 3.1 million, and I credited gain on the revaluation of land and buildings of 3.1 million. That gain that I'm talking about is other comprehensive income in my income statement, and that is closed off to the balance sheet or the statement of financial position and the equity as a revaluation reserve. Good. So that takes care of land and buildings. Now, the second thing that I had was I gave you in the beginning of the year medical equipment and machinery with a carrying value of 5.6 million and motor vehicles with a carrying value of 494,900 as at 30 September 2019 at the beginning of the year. They tell you up to 30 September 2019, 30% of the cost price of medical equipment and machinery had been written off as depreciation. So if I take that 5.6 million, I divide it by 70%, I will get the cost price of my medical equipment, 8 million. And then if I take the 8 million times 30% gives me 2.4 million, or 8 million times 70% gives me 5.6 million. So in that sentence, I have those three line items on my IS16 note. Okay, let's do vehicles first. The carrying value of vehicles, 494,900. So once you have a figure and they ask you to do a note, go and park the figure because you get a mark for that. And you haven't think one single bit to complete that line item on your note, and you're going to receive a mark, half mark probably, that should have taken, well, yeah, it's 2 marks per minutes. No, it's not 2 marks per minute. It's 2 minutes per mark. 2 minutes per mark. So that means that you have gained here some time. Now, they tell you that for the vehicles, we have written off the vehicles on the production unit method. They say that the total capacity of the vehicles being 200,000 kilometers, estimated residual values being 10% of the cost price of the vehicles. Now, during the year there was a change in estimate, and they have decided to apply the reallocation method for the change in estimate. Vehicles have driven 150,000 kilometers up to 30 September 2020, which is our current financial year. 40,000 was in the current financial year. So up to the beginning of the current financial year, they've traveled 110,000 kilometers. All the vehicles were acquired at the same date. Now, that means that the depreciation charge would have been equally over since the acquisition date from this asset up to the beginning of the year. So they don't give me, I have the carrying value that they gave me, but 494,600, but they haven't given me the split between cost and accumulated depreciation. However, if I apply my formula for the production unit method, I will be able to calculate the cost price of the asset. So if we go then here, let's go to the cost price of the asset. We say that the 494,900, i.e. the carrying value of those vehicles, equals the cost price of the asset less the accumulated depreciation. How do we calculate accumulated depreciation? By taking the depreciable value, which is the cost price, times 90%, because we envisage the residual value to be equal to 10% of the original cost, divided by the total capacity of 200,000, multiplied by the number of kilometers driven up to the beginning of the current financial year. They gave you the 150,000, which was up to the end, but they also gave you the current year's 40,000. So up to the beginning of the year, 110,000 kilometers. Grade 1 maths will then resolve this equation, and that will give us a cost price of 980,000 for the vehicles. Now, just by simply putting this old new thing next to each other, the cost price was 980,000. The carrying value at the beginning of the year 494,900, so the difference must have been the accumulated depreciation. If we carried on in the old way, we could have determined what would the depreciation charge have been. So that would have been our cost price, 980,000, times 90% divided by the capacity of 200,000 kilometers, multiplied by 40,000 kilometers, the number of kilometers driven. So that would have given us 176,400. The question says, the negative impact of this change in estimate on the current year's profits was 47,600. I'm not worried about future profits because they don't ask it. I want today, because today, 30 September 2020, being today, is the date of the IAS 16 note. So in the current year's profits will have an impact on the 30 September 2020 figures. So for that 47,600, it would have been a negative impact. So that means that our actual depreciation charge was 47,600 Rand more than the old method of depreciation, and that would have given us depreciation of 224,000. That's all I need for my IAS 16 note. So here in my IAS 16 note, I'm going to plot the 224,000, my depreciation charge for the year. Here I can complete my split between cost and accumulated depreciation now. The cost being 980,000 as determined, the 494,900 they gave me, and then the difference between those two, accumulated depreciation. I can also complete my closing balance. Cost stays 980,000. Accumulated depreciation will then be the 485,100 plus the 224,000, give you 709,100. So that was vehicles. If we quickly go and have a look at our medical equipment. Medical equipment and machinery are depreciated on the reducing balance at 20% per annum, and they gave you the opening balance carrying value of the equipment as well. Oh, that was the 80%, the 70% and the 30%. So I have the cost and I have the accumulated depreciation, the 8 million and the 2.4 million. Good. Now, where is the story about medical equipment? On 1 April 2020, the blue one there, a skin treatment laser machine was traded in for a new, technically more advanced machine. The machine was originally acquired on 1 May 2018 at 1.2 million. And when it was traded in, a profit of 8 million was realized. Guys, let's get rid of this asset out of our books first. They gave us the cost price. They gave us the acquisition date. So the cost on 1 May 2018 was 1.2 million. The first year end, remember it's 20% per annum on the diminishing balance method, i.e. on the carrying value as at the beginning of the year. So the first financial year ended 30 September 2018. 1.2 million times 20%, and then from the acquisition date up to the end of that financial year, 5 months have lapsed, so times 5 months gave us then 100,000 Rand worth of depreciation in the 2018 year. In the 2019 year, we've used it for the full year, and our depreciation is based on the carrying value at the beginning of the year, i.e. 1.1 million times 20%, which is 220,000. So that means that our carrying value at the beginning of the year on this asset was 880,000. We have sold or traded in this asset on the 1st of April 2020. So that means we've used the asset for a period of 6 months. So firstly, we had to determine our depreciation on that asset for the 6 months, being our carrying value at the beginning of the year, 880,000 times 20% times 6 months, 88,000 Rand. That 88,000 Rand forms part of our depreciation charge for the year. So the carrying value as at the date of sale, 792,000, and I can go and plot it on my IAS 16 note. Disposals at carrying value, 792,000 Rand. Thank you very much. Now they tell us that we made a profit of 8,000 Rand on this transaction. So that means that we have received 800,000 Rand, 8,000 Rand more than the carrying value on the asset. Now the new machine that we have acquired. SL had to transfer funds to an amount of 750,000 to the supplier for the new machine. This amount included the delivery and installation costs of 10,000 Rand, as well as the training cost of the staff on the new machine of 10,000 Rand. Now the installation cost, that's fine because we do capitalize installation costs, but we are not allowed to capitalize training costs. So what is now the cost price of the new machine? Now the cost price of the new machine would have been these proceeds of 800,000 plus the 750,000 that we had to pay in, less the cost included in the 750,000 for training. So the cost price being 1,540,000. The question then is also not straightforward because we did not start using it straight away, and we could not use it straight away. They tell us that the installation of the machine took place on 20 April and the machine was ready for use on 1 May. The training was completed on 1 June, and then we started to use the machine, but we were able to start using the machine on 1 May. So that is also the date that we start providing depreciation for. So from 1 May up to 30 September 2020 equals 5 months multiplied by 1,540 at 20%, and that gave us depreciation of 128,333. Good. Now that 1,540 cost price of new additions at cost, you can park that on your IAS 16 note, 1,540. The only other remaining thing to do is to go and work out the depreciation on our existing equipment, i.e. that equipment that we had in the beginning of the year and still have at the end of the year. Now, 8 million was the cost price, or 5.6 million was the carrying value of our assets at the beginning of the year. Let's go that one first. 5.6 million was the carrying value at the beginning of the year, and included there was the carrying value of 880,000 on the machine that we've sold. So we take that out. And that we multiply by 20%, and that gives us 944,000 worth of depreciation. Now, you could have also taken a longer route and you could have said, well, our cost price in the beginning of the year was 8 million. Included there was the cost price of the machine sold of 1.2 million. So the cost price of a machinery that we still have at year end is 6.8 million. Accumulated depreciation was in total 2.4 million in the beginning of the year, but included in that amount was this 320,000, those 2 years worth of depreciation based for the equipment that we've sold. So we're going to take that out of our opening balance of 2.4 million. That gives us 208,000, the accumulated depreciation on the assets that we still have at the end of the year. Sorry. So the carrying value of assets that we had in the beginning of the year and still have at the end of the year, 4,720,000, that times 20% gives you the same, 944,000. Total depreciation then equals the depreciation on the machine that we've sold, the 88,000, plus depreciation on the new one that we've acquired, 128,333, plus depreciation on the old machinery, 944. So give me total depreciation of 1160333, and I park it in my IAS 16 note. So now at the end of the year, what do we still have left? Well, we still have left cost price 6.8 million of old equipment plus 1540 new equipment. And that gives us the 8340. Accumulated depreciation at the end of the year is the 2,080,000 that we had in the beginning of the year, plus the 944,000, plus the 128,333, and that gives us then 315,2333, which is accumulated depreciation. And if I now test myself, 5.6 million plus 154,000 less 792,000 less 1160333 must equal, and does indeed equal, 5187667.